Hey everyone, let's have a look at statement of cash flow. I know we started talking about it last day, but let's go through an example together. So this one here is for Bel Air Inc. Okay, and in order to do a statement of cash flow, you need your other three financial statements so that you have all of your financial information basically for the period that you're trying to reconcile. So we're going to look at our statement of financial position, and it looks like we are trying to reconcile last year versus this year. Okay, so we're going to see, let's see the cash. So cash at the end of last year or the beginning of this year, we had 30,000. Now, at the end of this year, we only have 20. So we're down $10,000, okay? So basically what we're trying to figure out is where did that $10,000 go? We didn't just take 10,000 out of our bank account and give it to somebody. It went somewhere. And there's so many different areas in all of our financials that use cash or bring cash in. So for example, if we looked at our statement of income, our revenue, well, the reason we have sales is to make money. So of all of our revenue, that's money coming into our organization. So $2 million worth of money coming in. And then we look at our expenses, cost of sale, operating expenses, and income tax. That's money going out. Okay. We look over here, our retained earnings, that is our accumulation of profit. But dividends, that's money going out. We're paying our shareholders, thanking them basically for investing in our organization. That's an outflow of cash. Then we look at our statement of financial position. And we've got so many different areas that affect cash. Basically, almost every single thing that's on our statement of financial position affects cash. And there's one item that does not, that we have to take into consideration. So property, plant, and equipment, that's us buying stuff. So it went from 1.7 million up to 2 million. So we increased our asset called property, plant, and equipment. Well, if we bought assets, well, that takes cash, so our cash must go down. Okay, so there's a trend, and you can see here from what I've written that there is a trend in how we look at it. Okay, if an asset goes up or increases, such as inventory or trade receivables or marketable securities, if the value of that asset goes up, it means that we must have bought something. So therefore our cash decreases. However, say we had trade receivables, for example, here, they were 250 last year, now they're only 200. So our customers owe us less money. The reason they owe us less money is because they gave us cash. So therefore, if an asset decreases, we can say that our cash increased. Okay, so on the flip side of that, let's look at our liabilities. I'm going to copy and I'm going to paste this down by our liabilities so we can see it down here. Okay, so our liabilities we're saying is the exact opposite. If a liability increases, our cash increases. If a liability decreases, our cash decreases. One of the easiest liabilities to look at that we can see this is long-term liabilities. Okay, so at the end of last year, we owed 600,000. Well, now all of a sudden our long-term liability went up to 700,000. We must have borrowed 100,000. So our liability increased because we borrowed an extra 100. Well, what did we borrow? Cash. So our cash available has increased. So if our liability goes up, our cash goes up. But if our liability goes down, such as accrued expenses here, 20,000 down to 10,000, if our liability decreases, well, we must have paid it off, so our cash decreases. Okay, So that, in a nutshell, is what we're going to be looking at, okay? What's going on, and what we're reconciling to is cash. We know what our cash was at the beginning of this year, which is the same as the end of last year, and we know what our cash is at the end of this year. So it went from 30,000 down to 20,000. Our cash went down by $10,000. This is what we're trying to reconcile, okay? We're trying to figure out at the bottom of our statement of cash flow here, from all of the areas that affect cash, we're going to total it right here in change in cash for the year. So once we get that total, what the change is, we're going to add that to our beginning cash balance, and that will give us our ending cash balance. And that ending cash balance should match with what our cash balance is at the moment, our ending cash balance. Okay. Okay, so let's continue. Let's start at the beginning for our statement of cash flow. Okay, so what I've done here is I've already created the layout for it. So for a statement of cash flow, there's 3 sections, okay? The first section is your operating activities, and that includes all the day-to-day activities in your organization. And I'll go into the details of what's included there in a minute. The next section is our investing activities. And when we think about investing, what are we investing in or buying for long term? Okay, so we're investing in something to help benefit our organization. Well, we're investing in long-term assets, okay, and also intangible assets. And then financing. How are we financing those assets that we're investing in? Well, we finance by potentially selling more capital shares. And then to benefit our investors, we give them dividends. So that's an amount that would be taken off. So if we sell shares, that is money coming in from financing activity, and then we'd pay them dividends. So that would be money going out. And then also long-term borrowing, us borrowing cash to help invest, to finance what we're investing in. Okay. So those are the 2 big sections. So for financing activities, we're looking at share capital, we're looking at dividends, and we're looking at long-term borrowing. Investing as activities, we're looking in long-term assets, and we're looking at intangible assets. And now when we're looking at operating activities, we're looking at the profit for the year, which comes from our statement of income. And remember I said that there's one thing that does not affect cash that we have to take off of here, and that is the depreciation. And I'll show you in just a second how we do that. And then the other activities, the accounts that are affected on a day-to-day basis because of the running of our business, are short-term or current assets and short-term or current liabilities. Okay, so you've got your profit, you've got your depreciation, you've got your current assets, and you've got your current liabilities. Those are the 4 things that are included in operating activities. Okay, so let's have a look at what's going on here. So the first thing that we add into our operating activities is our profit for the year. Okay, so we go over to our statement of income. Our profit for the year is $125,000. Now, because depreciation doesn't affect cash, we have to add that back in. Okay, so let's go looking for it. Okay, so if we look at our statement of income, it doesn't list our depreciation expense. Well, that's because they've given us a very minimal list of what's included here. They've just given us a total for operating expenses. But there's another place we can go. Let's go look at our statement of financial position right here, right? Because the accumulated depreciation. So the difference between last year's accumulated depreciation and this year's accumulated depreciation, the way that change happens is because of depreciation expense. So we know that our depreciation expense for the year must have been 100,000. So we'd add back 100,000. Okay, so now let's go look at our change in inventory and the rest of our current assets. So if we look at our current assets, I'm just going to say, okay, equals what it is now minus what it was then. Okay, so if we know our inventory went up by 100,000, we know that it must have, our cash must have gone down, right? Because we know that if an asset other than cash increases, our cash decreases. So we're going to go equals that, and then we're going to multiply that by -1, just to show what the change is. And I'm just using Excel because it's a little bit easier to do the calculations. So remember, we don't want cash. We're not going to add cash in at this point because that's what we're trying to reconcile to. So I'm going to come over to my statement of cash flow and I'm going to go in equals there. So I know my inventory went up, so my cash went down. My trade receivables went down, my cash went up. My marketable securities went down, so my cash went up. Okay, so let's look at property, plant, and equipment. So again, it is saying that our property, plant, and equipment went up by 300,000, so therefore my cash must have gone down by 300,000. And intangible assets went up, so cash must have gone down. So I'm going to take those and bring those over here. Those go in under our investing. If it's easier, you can definitely do one section at a time. And I think I'm going to go back up now before I look at that much more and look at my current liabilities. Okay, so let's go over and have a look at our current liabilities. Here we go. So if we remember liabilities, if a liability increases, cash increases. So it follows the same pattern. Okay. So my liability went up. It went from 60 to 70. So therefore my cash went up. My accrued expenses went down. So therefore my cash must have gone down. Taxes payable didn't change. And short-term borrowings went up. So my cash went up. So we're going to carry those over here. And I've got taxes payable, but I don't need to have it there because there was no change. You don't have to include it if there wasn't a change. All right, so let's have a look and see. Remember to add the whole thing in, see how much. So my overall change in cash due to operating activities is $265,000. My overall change from investing is 400 in the negative. So it went down because I invested in these assets. So therefore my cash went down. So let's have a look at share capital. Actually, I'm going to end the video here because I'm running out of time. I will start a new one shortly. Thank you.